Ladies and gentlemen, please join me in welcoming with a very warm round of applause, Mr. Amit Bhosale.
Good afternoon, and first of all, thanks to Outlook Money for giving me this opportunity to have an interaction with you. My presentation today is essentially on what we believe on the credit investment philosophy. And my background, as she just mentioned, has been primarily in banking. For past 6 years, I have worked at ICICI Prudential Asset Management Company. Now, when I first came to this industry, I think the biggest difference I observed was that everyone inside the organization, outside, they were just enamored with these three letters called YTM, right? So it was just end of it all once you look at any investment opportunities. And in one of such interactions with our distributor partners, I had one of them asking me this question, raising his hand. He asked me the question that how long banks have been in operation in India. The answer is more than 100 years. And how long mutual funds have been in operation? And I mean 7 except one exception of the state-owned asset management company. The most others have been in operations for 25 years. So he asked me this question, and that got me thinking that why you think mutual funds will be able to avoid mistakes which banks haven't been able to avoid. And that got me thinking, and that's why I put across this particular construct. And I am comparing it with banks because banks have been the prime source of credit in this country. And mutual funds, insurance companies, provident funds, they have been coming, pension funds have been coming in a certain manner over the past few years. So I think the first and foremost important thing is that mutual funds in their construct don't have capital of their own, right? So it is basically sort of pooling in of investments from the investors and trying to invest it in profitable opportunities, generate a return, charge a fee, and then pass on those returns to their investors. So clearly, any credit investment which one tries to make, there is an investment thesis, there is a rationale behind it. And as one is investing, one hopes that that plays out over a period of time, and there is a hard stop in terms of the maturity, right? So there is absolutely no leeway available as far as the unexpected losses are concerned if you are looking at it from a mutual fund perspective. Banks have their own capital because they have to have, as per the RBI guidelines, they have to have their own capital adequacy. So to that extent, their ability to take shocks is much higher. The second point is that all the mutual funds, we are on the MTM regime, the mark-to-market regime. And essentially what it entails is that we have to fair value all our investments every day, and that's how we publish our NAVs, right? So to that extent, it is actually a good thing for the investors, but it also presents certain challenges. Because not all, as I mentioned, that behind every investment, there is a thesis or a rationale that has gone into it. Now, sometimes for factors beyond the control of that particular borrower or the issuer, there may be certain situations which may actually need patient handling. But since we are on this MTM regime, our ability as an industry, our ability to address those is relatively lower. The third aspect is the whole definition of default. 1 day delay is a default, period. So once it comes to capital markets, there is absolutely no interpretational issues or grace period available which banks have, right? So their ability to work with a borrower who is beleaguered is much higher compared to mutual fund. And the last most important thing, in my opinion, is actually the access to stable liquidity pool. So mutual funds, we have given in any open-ended scheme, you can basically have a one-day put option given to the investor, while the banks have access to stable retail deposit pools. So their ability to actually take shocks is again higher. So if you put all these into context, all these factors into context, what emerges is that you need to approach this particular these particular opportunities with the mindset of like a test match, right? It is not a T20 game. And why I say that is because a good test cricketer, a test batsman, is the one who tries to play as few delivery as possible, right? Because there is no incentive to score off every ball. There is no run rate imperative as far as test cricket is concerned, unless 7, except only few situations if you are chasing some target in the 4th inning. So to that extent, one has to approach it more patiently, and there needs to be a cautious approach to underwriting. Now, once we talk about test cricket, there are two aspects which people often talk about. That, there is one aspect of technique, the other is temperament. Now, technique involves the skills available or basically which are with you. And temperament is your mindset. So if one takes a look at both these things, one needs to put in place the architecture or the structure, how actually you will translate this global goal you have of approaching the whole investment paradigm from a test cricket kind of a situation. So the first thing is basically in terms of the portfolio construction, there has to be a segregation in terms of risk and investment functions. While the deal sourcing, the background checks and liquidity management, I think this is again a factor which is often underestimated as far as some of the recent episodes have taught us. But there clearly has to be that segregation, and linked to that is basically the independence of your underwriting team. Your credit evaluation can't be done by the investment team because there is just too much of conflict of interest, right? So while you have inputs coming from all those who are involved in decision-making process, clearly there has to be an independent team which is looking at the due diligence. And so essentially, in our fund house at least, the limits are set up by a team which is not reporting into investment team. So there is a clear segregation and an independent reporting authority as far as these two teams are concerned. I think another important thing which is clearly has been highlighted in the past few months is essentially you have to have a 4 eyes concept. What we mean by 4 eyes is essentially more than one person looking at the investment decisions. And this is because to just take out the biases one would have, and one may not be aware of those biases in his or her own decision-making process. So once you have got 3-4 people looking at each and every credit underwriting, I think those biases tend to get sorted out. So clearly one would need to approach any credit underwriting on the pillars of the quantum of investment you are proposing, the tenor of investment, and the riskiness of the investment. So essentially the rule of thumb is higher the amount, longer the tenor, and higher the riskiness, it has to go for approval to a senior forum. And that itself introduces a lot of checks and balances in the decision-making process. So covering the architecture, once you get the architecture, what we believe is there are these twin anchors of client selection and diversification, which are actually the most important thing as far as any credit investment is concerned. Now, the first and foremost amongst them is essentially the bottom-up approach. So while you would have heard many of my colleagues from equity side saying that they are bullish on a particular sector, and that's why they go and invest in, say, 3 companies from that sector, because ultimately sector is a summation of companies, right? But in credit, actually, the devil is in the minutiae or the details, right? So that famous Tolstoy quote that all happy families are alike, every unhappy family is unhappy in its own unique way. So every unhappy borrower or an issuer is unhappy because of the issues which are more or less firm specific. And if you want to highlight those, then you will have to approach them from a bottom-up perspective. The second aspect, and here I would actually, I'll spend a minute or two over here why it is important. Because the lack of depth in debt capital markets clearly hurts many of the investment theses should they not go according to plan. So it, in essence, it is like, if you want to deal with, always ask yourself the question that how would that particular borrower or issuer would behave should things do not go according to what you have planned. And that if you are still comfortable dealing with that person, then maybe you can look at it. That's one of the filter, I would say, for client selection. Because then you are essentially relying on, so there are two aspects of any credit investment, the willingness of the borrower and the ability of the borrower. While ability you can try to gauge through your due diligence and assessment of his financial strength, the business operations. But about willingness, it is still more a touch and feel kind of a thing. So this is one aspect, whereas I would say that any risk assessment would essentially be on a continuum of, if one side we say that it is total art, and on the other side if we say it is total science. Actually, I feel it is somewhere in between. It is a confluence of art and science. So like willingness aspect, it is very difficult to gauge ab initio. The good part is most of the mutual fund borrowers or the people who come to debt capital markets, typically, at least in India, they have graduated from banking. So new to credit, issuers are very few as far as the mutual funds are concerned. So that is actually a good thing to have, because you know that there is some track record with the banking sector before they come to borrowing from a mutual fund or from an insurance company. The second aspect is, while there are different securities, different covenants, actually they will, in a time of stress, there is a funny correlation which can get developed between these things which you have thought about from a certain perspective, and actually there may be some unintended consequences which could emerge. And for both the borrowers as well as for the lenders, there may be some unintended consequences or compulsions which may emerge at that point in time. We have to be very aware of that before we stipulate any of such covenants or security requirement. Again, on the matter of security, you would typically see, because this is one question which is often posed to the mutual funds, is that what kind of collateral do you take, right? Now, here is where there is slight difference between how a banking professional would approach a typical collateral in form of, say, plant machinery, the fixed assets, or hypothecation of the current assets. Essentially, it is because we are on this mark-to-market regime, and if there is a deterioration in credit profile, essentially we want collateral which we can get our hands on and liquidate and get our money back. But in most of the cases, when you can get hands on, especially all these fixed assets and current assets, is essentially when the firm has defaulted. Now, once the firm defaults, you already have the mark-to-market impact. So while I'm saying that can't be your basic thesis for investment. That can't be that collateral, you have adequate collateral, can't be your basic thesis. This is actually a good to have thing. This can work as a deterrent should your investment thesis not play out. The third thing which has been currently, which has got a lot of news coverage, is the role of credit rating agencies and credit rating as the input to your client selection process. There, I would say that one has to approach it like one of the inputs and not the sole determinant of your credit underwriting. And that is because I'm not, for a moment, I'm insinuating any lack of competence on part of rating agencies. They are doing their job. They have got certain constraints, and they have to. So they have to rely on published information. So To that extent, obviously, if those financials are not trustworthy, then obviously the input, if it is going to be volatile, the output will commensurately be volatile. So we would say that rating, you can use it as one of the inputs, but not the sole input. And that links, that gets me to the last point on this slide, is essentially the market perception. Now, market perception is still a very strong tool as far as client selection is concerned. You would have, let the rating agencies call any paper by issuer by whatever rating they want to connote, but the market has its own collective wisdom. And over a period of time, while there will be some short-term mismatches in terms of demand, supply and all, which may actually color the spreads for that issuer, over a longer period of time, these anomalies tend to get ironed out, and you may have a fair representation of the actual creditworthiness of that particular issuer. So to that extent, market perception does play a role and should play a role. While we are not in a very deep market like, say, US or Europe, wherein actually you can observe the market spreads and then try to swing it on to the probability of default or expected default frequency and have it parameterized, because the volumes available in our market are substantially lower. But clearly the markets are good, market knowledge is good in picking up the trends. So if there is going to be deterioration in any credit profile of any issuer, surely market or bond markets tend to pick it up faster than any other source of information. So that is one clear case for actually observing to the market proxies or market parameters. In fact, recent SEBI guidelines have also dwelt into that, and they have asked the mutual funds at least to factor these market proxies into their assessment. The other thing is still the debt funds are, there is a preponderance of institutional investors in most of the debt funds. So what happens is some of these investors have got their own investment constraints or guidelines with which they are governed. So to that extent, that also forms a part of what would be an acceptable credit or what is not. So that I think is one of the factors one has to be aware of. It's funny that I am invoking Comrade Lenin in a discussion related to capital markets, but I thought that's the most appropriate thing as far as the event risk is concerned. So event risk is essentially any risk ab initio, probability of which you are not able to ascertain, but clearly it has got a huge impact on your investment thesis. And so and most of the times it will be binary. Either that event will happen or that may not happen. In fact, if you look at recent past, there have been many events which you would have accorded a very low probability, but they have actually materialized. So to that extent, we have to be cautious of this particular aspect. And again, we are talking about debt investments wherein the upside is essentially capped. Right? So all stars were to align, everything going right, then you would have your spread, which you can get it. I still haven't come across any credit or debt investment which have returned some 10 bagger, 20 bagger. It is impossible. It is void ab initio. So to that extent, if your upside is going to get capped, why you want to get exposed to downside? So to that extent, it makes sense that you basically spread your risk. And while we talk about diversification, intuitively everyone is aware of the diversification on the investment side. But I think equally important is the diversification on your liability base. So as I said, preponderance is of institutional investors, and considering your investment side, you will have challenges if they were to liquidate their investments. So to that extent, at least in accrual funds, one should have a very granular liability profile. Ideally, one should put an absolute maximum investment cap for investment from a single investor. That will give rise to a very granular liability base, which can be much more stable. So just to recapture what the messages which I wanted to communicate is essentially, this is a game of patience. It has to be approached like a test cricket. Technique and temperament, both sides are important. In fact, if you ask me, more than technique, it is the temperament, which will play a crucial part in your portfolios being risk-free. The second aspect, again, the twin anchors of client selection, essentially not relying on a single metric for your investment decisions, looking at it from a perspective of a segregated and independent team, which is looking at every investment proposal once you are trying to originate and onboard it. And this most crucial aspect of diversification, wherein you are not putting all eggs in one basket. And there is a logic behind that because your upside is capped. So I think in nutshell, this would be the broad thought process with which one would approach credit investment. So that is pretty much what I wanted to communicate. I'm happy to have any questions answered. Yeah.
To get. To what extent does this distort the credit rating business?
I would say that I am on the questioning side rather than answering side, but let me at least take a, I think, see, as I mentioned during my presentation, that I'm not for a moment, insinuating that there was a lack of competence or, clearly they missed out some this thing. While, see, I look at it this way, as a mutual fund professional, all of us have got this fiduciary responsibility. All said and done, we have got, other people's money which we are managing, right? To that extent, there is alignment of interest as far as the investor and the mutual fund are concerned. Once you generate return, then only you will get basically, incremental flows and all. So to that extent, regardless of whatever rating agencies may be saying, we have to do our own due diligence. There is just no substitute to that. On your point of aligning the interests of the rating agencies with the kind of business imperatives they have, I don't know, but I have read a thought process which was emerging after the global financial crisis in US, that what essentially the SEC was trying to do was asking the rating agencies to invest part of the fees which they were generating by rating that issue into those issues only. So if you are saying that it is a risk-free instrument, it's fine. You will get that once it matures. So I don't know, there may be some merit in pursuing those things, but again, it's beyond my remit to advise on that. Yes.
So the question on a portfolio which has these instruments, out of which one becomes untradeable, or the market now knows that there is some problem going to come in this particular company's paper. Let's just take Vodafone just as a name, as an example. So you have a credit risk fund out of which 3% of your portfolio is Vodafone. Now you know that it's not saleable because nobody is buying it in the market. However, because it has not been segregated as yet, smart money takes the money out, and you, instead of selling that 3% which is not saleable, you are actually selling more of what sells. So the person who's now invested for the long term is actually losing out, right? This is what has actually happened with the PSU fund, credit risk fund, which you said. Shouldn't there be this be corrected? There is a problem with this, right? The smart money is moving out early and the retail investor is actually losing.
So we don't have.
No, so I did not take your name.
So, no, and I think it is unfair for me to comment on a specific.
So don't comment on the fund house, but as a structure.
I'm actually, the approach, again, I'm going back to that, is first of all, you view it like, it's a held for maturity investment. That's the first thing. If you're comfortable holding that during the life cycle, have it. There will be some event risk, right? I think the only antidote, as far as I can think of, is managing the concentration. I'll give you an example, just hypothetical, say for ease of calculation. Suppose your portfolio YTM is 10%. Suppose you have got 2% of that, let's assume 2.5% of one particular paper in that portfolio. Assuming you write off the entire thing, still 1 quarter's return would recoup your principal. Right? The situation changes moment you have got, say, 8%. Right? So there is a clear this thing, and I'm not for a moment saying that, this is again a common thing that, people say that I'm God. Right? I think that there is no God as far as, knowing everything is concerned, and there is no dog either. Most of us are in a continuum between dog and God. So how to, preempt this particular event risk? To me, the only mitigant is avoid concentration at all costs. Again, what are you going to gain? I mean, the equity guys can have a conviction, but if that call plays out, then you have got a above average returns to make, right? Here, and all said and done, debt mutual funds at least, benchmark is not looked at even from an investor perspective. It is basically absolute return which they are looking at. While the equity guys have got that imperative also in mind that they have to beat benchmark. So to that extent, I think if I'm not sure of whether that event will materialize or not, it's better to be safe than sorry and avoid concentration.
But there are a lot of portfolios who actually became from 2.5 to 8 because of what I told you, because a lot of money moved out. Right?
Then the other antidote which comes in is the diversification on the liability side. And that's why I made that point. While everyone looks at the investment side, this what you call the so-called smart money, that is basically a money which is coming in a chunk, and it will go out in a chunk. So the antidote to that particular situation is to have a well-diversified liability base.
आई एम संजय सिंघानिया फ्रॉम रिद्धि सिद्धि फाइनेंशियल सर्विसेज। मुझे सिर्फ इतना जानना है कि अभी आपने थोड़ी देर पहले बैंक का और म्यूचुअल फंड्स का थोड़ा बताया था, तो मुझे ये जानना है कि आज हमारे म्यूचुअल फंड्स के अंदर ट्रांसपेरेंसी है कि इन्वेस्टमेंट्स कहाँ होते हैं, कैसे होते हैं, और लैंडिंग का भी आपने बताया जैसे ट्रांसपेरेंसी होती है म्यूचुअल फंड्स के अंदर, तो वैसे बैंक्स के अंदर नहीं होती है। फिर भी आज हमारे देश का काफ़ी बड़ा पैसा फिक्स डिपॉजिट्स में होता है, जिसके अंदर हमको पैसा टैक्सेबल होता है। यहाँ पे हमको 3 साल का बेनिफिट मिलता है डेट इंस्ट्रूमेंट का, ठीक है। तो हम लोग किस तरीके से या कैसे जनता को अप्रोच किया जाए कि उनकी आंखें खोली जाए, या तो बैंक्स ट्रांसपेरेंसी में आए कि हम लोग कहाँ लैंड कर रहे हैं, या फिर हम लोग जो म्यूचुअल फंड्स को प्रमोट करना चाहते हैं कि इतना ट्रांसपेरेंट होने के बावजूद लोगों में विश्वास पूरा नहीं है, तो व्हाट शुड बी द वे कि अप्रोच किया जाए उसको, किस तरह से उसको लोगों का पैसा सेव किया जाए। एक्चुअली यहाँ पे सेफ है, लेकिन जो नीचे के टैगलाइन आती है म्यूचुअल फंड्स की, वो बहुत भारी पड़ती है कभी कभी, क्योंकि नेचुरली इन्वेस्टर्स जो होते हैं 50+ वाले ज़्यादा होते हैं। उसके लिए आप थोड़ा हमको बताएं प्लीज।
Actually, I may not be the person most equipped to answer that, but I'll try, and don't hold it against me, please. but essentially, I think, अगर मैं English में बात करूँ चले? So essentially, in a journey of a development or a growth of an economy, and this is a global precedent, that once your GDP starts growing up, more and more people move from being plain savers to investors, right? So, our jo pura efforts, I think mutual fund as a whole industry is doing is basically to capture those, and this we have seen, right? In 2014, you go back every 5 years, right? There is clearly an increase in the AUM which the mutual funds have got. And the most logical place wherein a new investor can come in is essentially a liquid fund, right? So you basically park your surplus, build a traction of good experience with these funds, and then evolve into other this thing. I think as the natural progression of economy happens, some of these issues will automatically get addressed. They have been, by the way, right? And I think somewhere the whole focus on the digitization, right, which is coming in from all quarters of government and banks and mutual funds, I think that is going to help this process to expedite this process. So जो भी थोड़े बहुत impediments थे, the constraints which were coming in, I think they are slowly getting ironed out. But ultimately, the transparency will be one big calling card as far as mutual fund would be concerned. Again, as I said that, I'm not the absolute authority to opine on that.
Well, Mr. Bhosale, that's
Thank
all
you.
the time we have for today. Ladies and gentlemen,